investing because of fear of missing out or you only live once, that is not an investment strategy. And I love what you said there, that you need to align your investments with your financial plan.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. How about that, Cory?
Got the applause
Cory, welcome
button
back
working.
to the show.
Thank you.
Do you have any personal highlights or updates for our listeners before we dive into today's content?
Yesterday, actually, I have one, Jake. Today is 99 days for my wife's due date. So we are counting down the days and getting ready to bear down, but we're really excited.
You know, I think I had a client or somebody told me that we should start a pool on guessing when the baby comes. I think we need to do that, Cory. So I'll put that on you. You get to start the office pool on when the baby comes.
You want me to start it?
Yeah, it's your baby.
Okay. All right. I'll give Cassie and the baby instructions on the right day to pop out.
No, I don't think you.
I don't think it's going to work that way anyway.
I think it's for the rest of the office. The rest of the office gets to pick a date and time when the baby comes. We'll start a pool.
It's only a few days after my birthday. So what's new with you, Jake?
Not much. I played another round of golf here locally in Kansas City. It was a nice, kind of a warmer day for this time of year, so I took advantage and played some golf. I had a lot of good time. I had a lot of fun. A lot of good time. Had a good time and had a lot of fun. Played pretty well, Cory. So I'm excited. The Falcon Wealth Advisors tour is fast approaching. So if you don't know what that is, I would encourage our audience to head on over to Central Links Golf. Check it out. We do sponsor a local amateur tour. And so that season will be kicking off here, I think, in April, Cory. So stay tuned for more updates on that. And yeah, that's what's new with me.
Excellent.
All right. Well, now it's time
to play ball.
All right, Cory, kick us off.
Here's an email from a listener. Good morning, Luke. Solid podcast, good info. Thanks for broadcasting. My investment advisor said I can take distributions from my 401k at age 55 without the 10% penalty. He also said I could do something similar with my IRA. Can you cover this on your podcast? Thank you.
First off, thank you for the listener for sending in a suggestion to Luke. And again, if you have a question or topic you would like Cory and I to discuss or debate, feel free to email Luke at falconwealthadvisors.com, and your question may be spoken about live on Uptick. So thank you again for the listener. Your advisor is correct, but there are certain rules that do apply to your 401k. So as a quick update on that, if you leave your employer the year you turn 55 or older, as long as you leave the funds in your 401k plan, you may be able to access those funds without paying a 10% penalty. Now, if you have money in an IRA, Cory, and you know these rules, so I know you're agreeing with me, but if you have money in an IRA and you're under the age of 59 and a half, there are two avenues you can go down. So one, I believe it's disability, basically a hardship type of withdrawal. So if you can prove that you're disabled, you may be able to access your funds without the 10% penalty. You can use them for education, a first-time home purchase, right? So there are some minor stipulations there. But your advisor may have been referring to another rule that's called 72T, and that is the IRS code for said rule. And Cory, I won't talk about this the whole time. Why don't you explain 72T to our audience?
It is a way for someone to take distributions from their IRA before age 59 and a half penalty-free. There's a lot of details and nuance that's involved with it, but the key takeaway with the strategy is that ultimately if somebody does begin taking 72T distributions, Jake, at 54 years old, for example, they need to take the same amount consistently until they turn 59 and a half or for 5 years, whichever one is longer.
Right. So, and they need to be substantially equal periodic payments
Yep.
You don't get to choose the amount necessarily. It's based on the federal midterm interest rate. So again, there's an interest rate that's published. They take the value of your IRA and they use that as a calculation. Now, you don't have to take the max. You could take less than the max. So like you said, Cory, there are a lot of stipulations. There are a lot of rules.
Yes.
You and I have actually done a lot of 72Ts for our clients in the past.
Yes, we have.
What's really fascinating about this, and again, for our audience to understand, is that the custodian typically doesn't really calculate this for you or monitor it. So it's on you to make sure that you get the calculation correct and that you follow the rules. Because if not, the IRS may audit you and you may end up paying tremendous amount in penalties. So this is not something you want to do alone. You certainly want to work with in my opinion, a chartered retirement planning counselor, such as myself or Cory, who has executed these strategies on their clients' behalf before. And I would run this by your CPA or accountant just to make sure they know what you're doing so that when they're filing your taxes, that they can make sure that your 1099-R and all that stuff from your IRA is coded correctly. So good for your advisor to point it out. And again, it is a little bit complicated, but you certainly can do it. You just want to make sure you do it the right way and that you keep accurate records of everything.
Very good.
That's a good one. Did I miss anything there, Cory?
Nope, I don't think so.
All right, we got another one from our audience. So before we dive into our headlines, we got another one here. And I think this is pretty funny, Cory. Somebody sent you a chart. Are you kidding me? Or did you sneak this in here?
Not kidding you.
All right. So it says chart of the week from the audience that knows how much Jake loves charts. I don't love charts, Cory. Why don't you go over this one? Hopefully this is the only one we're having today.
It's the only one we've got today. We're going to keep that limited. So what this chart's displaying is the average price of two luxury handbags, the Hermes Birkin and the Chanel Flat Medium. And starting in 2012, that Chanel bag.
Hold on. Does Cassie have a Hermes or a Chanel purse, Cory?
No, she does not.
Why not?
2012 would have been the time to buy them.
All right, go ahead. Keep talking about your
But yes, so going back to 2012, the Chanel Flap Medium bag, the price was around $4,000 to $4,500, and the Hermes Birkin bag was just shy of $8,000. Fast forward to today, that Chanel bag that was $4,000 to $4,500 is over $10,000. That Birkin bag that was just shy of $8,000 is over $11,000.
Now, do you know much about these?
I do. A decent amount, I guess.
It's my understanding, my wife knows all about these, and she doesn't have either. We did buy her a Celine, I think is what it's called, in Paris, which I think was cheaper. And I think the Hermes one, Cory, you have to be invited to buy it.
Wow. What a model.
Great. Did you know that?
No, I didn't.
You can't walk into an Hermes store, this is my understanding, and just say, I want to buy a Birkin. No, Cory. They're going to say, no. We have to invite you to give us $10,000 for this purse. Isn't that crazy?
You think if you walked in and had $10,000 cash in your hand,
you
could ask, am I invited now?
No.
Okay.
Rachel says no, Cory. They'll say no, sir.
Okay.
No, sir, you cannot.
There's a challenge for the next time I'm somewhere where either of those stores are around, Jake.
I ain't gonna do it. But anyways, so what are you guys saying from this chart? What are you trying to get at?
Do you think investing in luxury items is a smart investment for people to consider, Jake?
No, because there's no intrinsic value there. I think I still favor publicly traded companies because there's earnings. Your purse isn't going to earn you any money. It's only worth what somebody is willing to pay on any given day, but it's not producing anything. Like, I'm not going to mention stocks for compliance reasons because I don't want people watching this show or listening thinking that I'm pitching them a stock. But, Widget Factory makes widgets that do something, that generates something or whatever, right? So it's creating revenue and creating, a service or a product. It's fine to buy them and collect them if that's your thing. I'm not saying, by the way, there's no shame. If you have a Birkin and you're watching this show, good for you. I think they're beautiful purses. And who knows? Maybe I will get Rachel one day, right? For years, didn't your wife want a Chanel? Doesn't she still want one?
She still wants one.
And I think they're beautiful. So
sure.
Again, I think they're fine. If that's what you want to spend your money on, that's completely fine. There's no judgment here. But as an investment, no. But is that what's the point of this chart? Are they just saying Chanel has become a lot more popular than Hermes over the last decade? Is that what it's trying to say?
Yeah, and that really over the last decade, luxury handbag prices have moved higher. Okay. And a lot of it's been around scarcity, which is an interesting model.
That's what I'm telling you. The Hermes, Corey, you can't just go into a store and buy that. Isn't that crazy? Good for them.
And that just makes it more expensive,
That's
I
awesome.
guess.
That's awesome. That's a interesting tactic, and it clearly is working.
Yep.
I think
No
both
doubt
those
about that. Okay.
I think both those brands are doing great. So, anyways, good. Thank you for the listener. Please keep the charts coming. Good for Hermes and Chanel, charging a lot of money for their purses. And quick plug here for Upticks. I'm very humbled. Our subscriber count continues to grow.
Yes.
Please subscribe, like, share this content. The whole reason Corey and I are taking time out of our busy schedules is that we want to enhance financial literacy. We don't do that if no one watches the show. So please tune in, share, like our content. If you're not subscribed to our weekly newsletter, simply email Luke at falconwealthadvisors.com, and he will make sure you get an email sent to your inbox every Tuesday where we have the full transcript, not the full, but a transcript of Uptick. So you can read it, you can watch it, you can listen to it, all available to you in our weekly newsletter. All right, Corey, let's move on to our headlines.
All right, Jake, the surprising effect friends have on our finances.
Yeah, and I think we've talked about this before on a previous episode, Corey, but it's a sad reality that peer pressure does play a role in our spending habits. And that's what this article talked about,
Yep.
specifically social media. So, Corey, you might have been posting pictures of you out there on your baby moon, and your friends might have been a little envious and saying, wow, Corey's always jet setting. And you're not, but Corey's always jet setting the globe. How does he afford all that? Maybe I should be doing that. So the point, though, Corey, is that that can be misleading. A lot of times, think about it, too. If you're scrolling through Instagram and let's say you've got, who knows, 200 friends or followers, whatever it's called, well, maybe your friends and followers are only posting when they go on vacation. And if those people only go on vacation once a year, well, you're still seeing that 200 times a year potentially, right? So social media can mislead you into thinking that people are always spending money and doing these lavish things when maybe they're only doing it once a year. So again, if you think your friends are always traveling the world and have tons of cash, don't get caught up in it. We advise our clients to check in with what they value and why is money important to them. Then all you simply need to do, Corey, is align your spending with what you value and cut the rest. And this is a good reflection on your chart. There's no judgment here. If you want if you get invited, Corey, to buy a Birkin for Cassie, you better buy that if that's something that she values. And maybe you guys don't waste money at, I don't know, maybe you don't buy Beanie Babies, or maybe you don't, I don't know, maybe you don't go out to dinner a lot or whatever, right? So
Yep.
it's okay. And I tell this to other people too, as long as your financial and savings and retirement goals are accounted for, you're paying off your debt and your bills, whatever's left over, whatever cash that equates to, that should be guilt-free spending, and that should be fine. But the key takeaway here of this, Corey, is to not get caught up in what your neighbors are doing. All right. Got anything to add there, Corey, before we move to the next one?
The round of applause. I like it.
For myself.
Just a quick funny anecdote, but it's aligned with this. It was a year or two ago, a few friends in St. Louis where I grew up that would text me during football season, during Chiefs games. And they would ask me, they're like, does everyone that I know that lives in Kansas City go to every single Chiefs game? Because it looks like some people are posting pictures at every single game. Exact same observation that you talked about with vacation.
Yeah. So good one. Don't get caught up in the social media. You're not seeing the whole story.
No.
All right, good, Corey. Let's move on to the next one here. All right. Let's discuss what someone should do if they are receiving an unexpected tax refund or if they're making an unexpected tax payment. What are your thoughts here, Corey?
Yeah, this is timely. And I've had multiple conversations with different people. Tax time here. People that are getting money back that they didn't expect. People that owe money, perhaps, that they didn't expect. And I just wanted to have a conversation about this, Jake, to kind of frame ultimately what this looks like and what it is that we share with our clients. And I'm curious, Jake, what do you tell someone who's getting an unexpected refund back from their tax return?
There's two things that typically go on with this, Corey. One is the psychology of it.
Mm-hmm.
Many people that get refunds or large refunds, they see it as a windfall or a bonus, and they actually start to depend on it from a psychology standpoint, which I don't necessarily love, but I'm also not going to disagree with. If you feel like you need to overpay your taxes to force discipline on yourself and have that travel fund sent to you back from the IRS. While I don't think that's the best thing to do mathematically, if that helps you from a psychological standpoint, it might not be the worst thing for you. But what I do generally tell people, Corey, if they're getting $5, $10, $20,000 in a refund, that they should go through our tax planning process and try to avoid that in future years, because you are prepaying your taxes and you're overpaying, and that's why you're getting a refund. So refunds aren't necessarily a good thing. We need to do some more tax planning. You need to meet with your CPA and figure out why that occurred. So there's two things. First, Corey, I want to check in from a psychological standpoint and see where they're at. And if they don't care either way, then I say, let's go through our tax planning process. Let's meet with your CPA. Let's see how we can lower that refund next year. What are your thoughts?
I think you did a great job of highlighting both of those points. The one piece I would add is that particularly for someone who's retired, if they're taking distributions from a retirement account and they're withholding taxes from that retirement account, and then they're getting those taxes back when they file their tax return, if they're ultimately going and spending that money, I just think it's important to highlight that that means your spending may actually be higher than what it is that you think, because those are dollars that did come out of your retirement account. They came back to you, but if those aren't factored in into part of the plan, it means the monthly distributions that you're taking are not perfectly aligned with your spending if there's a big refund that's getting spent elsewhere.
Yeah, good. So you want to adjust your financial plan. And then to your other point, if somebody has to pay a lot, that's
Yes.
painful. I get it. You definitely want to do that. You don't want to get behind with the IRS. You may be able to set up a payment plan, though, if you literally don't have the money. And so, again, just be open and transparent and honest with the IRS and work with an accountant or CPA. If you need to set up a payment plan or whatever, get that taken care of. And then again, same applies. Let's go through our tax planning process and see what happened to cause that, so that hopefully you don't have an unexpected large payment next year.
The other point I would add to that, Jake, is that if you do have a tax bill and it is a consequence of capital gains, that does mean that you made money. And it does mean that there's tax planning that we can ultimately do for our clients that you've talked about here today, Jake. But it is not a bad thing to owe taxes on capital gains, because it does mean that you made money. So having the appropriate expectations. Thank you. How about that round of applause? That button sounds like it's working great, Jake. But
Gains are good. You're right. People get caught lost in that, Corey.
Yes.
They're like, hey, I got a 1099 from you guys or Charles Schwab, whatever. I owe all this money. Well, it's because we sold high and we locked in gains. And again, we want to mitigate your taxes, but we're also here to make money. And when you make money in a taxable account and you realize that gain, you have to pay taxes on it. And again, that's much better than the alternative of losing money and not owing any taxes. So good point, Corey. I think people miss that sometimes, and they have to understand, yes, most all of us don't like paying taxes. I get it. However, if you had a great year in the market and we sold some stocks while they were high and you have to pay some taxes because of that, so be it. You made money. Let's move on from that. Good one. Good point.
All right. Let's move on, Jake. We're paying for our daughter's wedding. Is it a taxable gift?
Great question. Corey, I don't know about you, but most of my clients are paying for the majority of their daughter's weddings. And they are typically higher than what the gift tax limit allows for, which is $18,000. Now, again, if you're married, so husband and wife could each give their daughter $18,000. So it can add up pretty quickly. But the answer is no, according to this article. But the key here, Corey, is to not give your money directly to your child. Instead, you want to pay the vendors. And so I thought that was a good tip there, is that, let's say you're paying $50,000 for your daughter's wedding. You want to be careful not just write her a check for $50,000, because that could go against your lifetime tax exemption. So just pay the vendors directly, or make sure that you're staying under that $18,000 threshold. Have you have any experience with this that you want to share?
No, I'm really glad you're talking about it, though, because it is a common question. And I don't know if anyone has specifically asked me this question before, but what you've talked about here makes perfect sense. And I do think that it makes perfect sense to me also that paying the vendors, as opposed to, my mother or father-in-law writing a check to me for my wife and I's wedding, makes perfect sense from a record-keeping standpoint. So that's good. I'm glad you brought it up.
Yeah, and I've had clients open a joint account. That's probably not the worst idea either if you wanted to open a joint account. Again, as long as you're not outright gifting more than that threshold, you're probably fine. Again, something to double check with your CPA if you're really that concerned about it. All right, Corey, how to invest in a bull market. Are you suggesting we're in a bull market?
The Wall Street Journal was. Play ball.
Charge.
Charge. Is that different than the one that you played at the beginning of the show?
No.
Okay. I was like,
Is
am I
it
just hearing
charge
them
or
two
play
different ways?
ball? Is it charge or play ball? You're the
I think
baseball guy.
I think it could be both. So
Anyway, charge
I
for
think
the bull market.
there we go. I like it. So this was an article in the Wall Street Journal. I thought it was a fun read because they interviewed, Jake, 4 people that are talking about how they're adjusting their investment strategies in light of the current market conditions. I thought it was interesting though. All 4 people that they interviewed were in their 30s. 2 of them were full-time day traders, and 3 of the 4 people, from my perspective, were really talking about FOMO, which is the fear of missing out, and YOLO, which is you only live once. And that is a big part of their investment strategy, which I do not agree with.
That's ridiculous, Cory. Anyways, keep going. That's why
All
I
right.
laughed.
Yeah, okay, good. That was a big part of their investment strategy. And I think
Was FOMO and YOLO, was their investment strategy?
yes, the way that they were adjusting their portfolios was to go buy everything that other people are buying and to do so in large size.
And large, like go all in?
Yes.
Jeez.
YOLO. So I think the takeaway for me, though, from reading that, so it was fun, interesting to read, but the main takeaway for me was that you need to align your investments with your financial plan and your individual goals, so you're not left questioning how you need to adjust your portfolio for different market conditions. Talk to your advisor and ultimately be careful because just reading some of the stories in here about the approach that these people were taking, just made my skin crawl a little bit, Jake, admittedly. And I think that whether it's a bull market or a bear market, that really comes down to semantics. Your investment strategy, your financial plan, and your goals should be relevant regardless of market conditions.
Yeah, I heard this from another podcaster or a blogger, and they commented on the past Cory, like, where do they find these people that the Wall Street Journal interviews?
I don't know.
Because that is scary. I mean, I don't care if you're in your 20s, 30s, 40s, 50s. If you are investing because of fear of missing out or you only live once, that is not an investment strategy. And I love what you said there, that you need to align your investments with your financial plan. It's that simple. And day trading and all that is just garbage. Like, you can't do it consistently. These people, there's people that are extremely intelligent and in tune with the markets who have advanced degrees and have dedicated decades of their lives to studying the market, and they can't day trade. So why does some kid in their 30s think that they can magically predict the future? It's stupid. It's risky, and it doesn't make any sense. So
I laughed, though. There was one person, Jake, in this article that literally talked about how their emergency fund, which they had invested in a CD, matured in January. And because market conditions are different now, they felt their emergency fund, the funds that were in a certificate of deposit, should be invested in 4 stocks because the market's changed.
That's so
first person interviewed. So anyway, I wanted to bring it up because I do think, sentiment drives a lot of things. How people feel about the market, whether things are moving higher or lower, and how they need to adjust along the way. I do think that keeping yourself centered and focused on what matters and is the most important in your plan is crucial.
Right. And let's talk about that. I want to answer this question. So how do you invest in a bull market, Cory? I'll tell you.
All right,
So
let's hear it.
Number one, your emergency savings should be in a high yield savings account. Quick plug, we have a relationship with Goldman Sachs where we can help you do that in a pretty good yielding savings account. Number 2, any money that you think you're going to need to live off of in the next 1 to 5 years should be in some sort of certificate of deposit, treasury bond, corporate bond, something more safe than stocks typically, somewhat liquid, and earning you some sort of interest payment, 4 to 6%, whatever that is that you can get. And anything that you don't need for 5, 10 years and beyond should be invested in a diversified portfolio of stocks. Now, again, for compliance purposes, this is not advice. I'm just saying, regardless of a bull market, this strategy applies because we don't know when the bull market will end. We don't know when the bear market will start, and vice versa. And so you should just be aligning your money, your capital, with your goals, and short-term, long-term and long-term. Get that lined up, and don't worry about FOMO, YOLO, and what XYZ stock and ABC stock are doing, or what your neighbor's brother, sister's dog are doing. Line up your money with your plan, and let's do that. Let's check in on it. Let's update it. Let's review it. Let's do those things. Not day trade. That's silly.
All right.
Crazy.
Well
That's my
said,
rant.
Jake.
All right, we got time for what do we got time for? Two more, Cory.
All right. Over 50 years old, don't miss these tax breaks before April 15th.
Yeah, so again, it's not too late to lower your 2023 returns, according to this article, Cory.
Hmm.
If you are still employed, you may be able to make a deductible IRA contribution.
Hmm.
You can look at your health savings contributions. Be aware of the standard tax deduction. You could potentially write off your medical expenses if you are itemizing, or maybe long-term care expenses. Also, you need to understand that your Social Security may be taxed. So the key takeaway here, Cory, is to go through our tax planning process. And as always, double check everything with your CPA. But it's not too late. We're recording this in March. So again, make sure you've got all your ducks in a row. If you can lower your 23 return and have an opportunity to do so, definitely take a look at that. But again, your friends at Falcon Wealth Advisors, we can take you through our tax planning process. All you simply need to do that is we need a copy of your 2023 or 2022 return. Email service@falconwealthadvisors.com, and our team can walk you through how best to get that return to us. Don't email your return to us, but we can talk about how best to get that return. We'll do the analysis, and we'll take you through this tax planning process to see ways that we could potentially look to lower your lifetime tax bill. Again, everything needs to be scrubbed with your CPA, though. Cory, any other thoughts on this?
No, that's great.
Yeah, good. So let's wrap up. We got time for one more.
Okay.
Let's discuss considerations for someone choosing between a single life pension option and a joint survivor option.
Yes, I just had a conversation with a client yesterday about this, and I wanted to bring it up and just talk with you on the show about it, Jake, because we work with a lot of clients that have pensions available to them. And I wanted to know, if we think about a single life option, which is if I've worked somewhere for 30 years and I collect a pension for as long as I'm alive in retirement, but upon my passing, it's gone, versus a survivor option where my spouse, where Cassie may continue to receive a portion of the pension. I'm curious, Jake, how do you go about approaching this and having this conversation with the client? What the best route for them to go ultimately is?
Yeah, thank you, Cory. So you're right. We have a fair amount of clients that still are eligible for pensions, and these are annuity payments by their company. These aren't lump sums that you're talking about. And again, we're not recommending an annuity. Your company would pay you an annuity for either your life or you and your spouse's life, for example. So first thing first, Cory, we plug it into the financial plan. So I would look at both options in a plan, and then we'd have our planners run some doomsday scenarios just to see what would happen if something bad happened to you or your spouse. And we want to see mathematically which one makes the most sense first. Again, we're still dealing with a large unknown. Then a strategy that we often deploy is if somebody wants to get the full max and take that single life, we'll also look at getting some sort of inexpensive term life insurance for maybe 10 or 20 years to bridge that gap. So in their early retirement years, if something unforeseen happens to them, their spouse is covered with some sort of benefit. So there's many different roads we can go down, but it all starts with a financial plan, Cory. We'll plug in both options, crunch the numbers, and then we'll look at different avenues at what makes most sense. There's a big risk here. First, your company has to stay solvent enough to keep paying you the pension. You also don't know your life expectancy or your spouse's. You don't know it with certainty, at least. And so we got to crunch those numbers and those variables and help you make an informed decision. There is no right or wrong answer, and there is no one size fits all. It really boils down to your situation. What about you? What do you say?
You just said pretty much everything that I would say, Jake, but I do agree with what you said. I think the most important detail that you shared there is that there's nuance involved, and it's really individualistic for someone's individual plan. It doesn't really matter what a former coworker or friend or someone else that works at the same company may have done when they had to make the same choice. What really matters is what's best for you and your plan. And there's no reason to jump to any conclusions or make any assumptions. Go through the exercise, see what impact the plan has, weigh the pros and cons, talk with your advisor about it, make an informed choice so you can go and, ultimately make that decision with confidence.
Right. But this is right in our bread and butter, Cory. This is what we're happy to crunch the numbers on. And our planners are well equipped to help you look at the numbers, weigh the pros and cons of each decision, and hopefully help you make the best informed decision of what the information that you have today. And that's all we can do when we move forward. So good. I'm glad you brought this up because it's a very popular topic, actually. A lot of things that we discuss with our clients. All right. Very good, Cory. So now we're going to wrap up today's episode. Do you have any final takeaways for our audience?
Send us any articles, any subjects, any charts, whatever it might be that you're interested in hearing us discuss or debate for the show. Jake, I think you and I both very much enjoy when other people are posing subject matters for us to talk through. And I recognize that if one person has the question, I'm sure a lot of people do. So please feel free to reach out to us, send us that content because we want to talk about it. We're happy to do it. And that's why we're here.
Yeah, thank you, Cory. That's a really good point. Again, we love finding articles and sharing it with our audience, but also we understand that this content is for our audience. So like you said, simply email luke@falconwealthadvisors.com, and we're happy to talk about your questions or comments live on air of Upticks. So thank you again for joining me, Cory, and thank you all for tuning in. We hope you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.